Hello, everybody. We are going to get started today. Wanted to welcome you and thanks for joining us today for our lunch presentation on Introduction to Cost Segregations and the Related Tax Benefits. So if you're doing a new construction project or doing expansion on your current building, you're in the right spot because today you'll learn about some tax saving strategies and things that maybe you should be considering. We'll discuss the tax savings that could assist in financing your construction project and or improve your cash for other initiatives or liabilities. I'm Carolyn Powell. I am your host today and walking you through real quickly. I'll touch on some general housekeeping. There is a toolbar to the side. In there, you can find a copy of today's presentation, bios of our experts, and there's also a question box. In the question box, submit any questions that you have for our experts to answer, but also shoot in there for me, kind of that aha moment. Let me know that one nugget you're walking away with today that's going to be able to help you. We'd like to hear from you and engage with you. So put your notes in there for me, or even put in there what you're looking to gain out of today's webinar. After the presentation today, you'll receive a quick exit survey. If you could complete that, that would really help us out. Let us know what was helpful. And again, if you want to meet with any of our experts or talk with them following the presentation. This afternoon, I will send an email to everybody with a link to the recorded session and again, another copy of the presentation so that if you want to share it with somebody or if you want to go back and watch something maybe you missed. So that is how you can engage with us and get your questions submitted. So without further ado, we'll get started today. Tronconi, Segregating Associates is a public accounting and business consulting firm. Our experts today are John Callahan. He is a CPA and partner here at the firm with over 20 years of experience in public accounting. Some of his industry expertise are with auto dealers, manufacturers, real estate entities, and distributors. Mike Zioli is also with us. He is a CPA and a senior manager here at the firm. And some of his industries that he works in are manufacturing, wholesale and retail, construction, healthcare, real estate, and high net worth individuals. So real quickly, before we get started today, we're going to do a quick poll just so our experts can get a little bit better understanding of where you are. So I am going to launch this. Hopefully everybody can see the question of, do you have a new construction or expansion project already? Just give everybody a couple minutes to see where you're at today. I got a couple people that are curious and learning. So a couple people in the middle of their project and some people with the project starting soon. So guys, this will help you relate to your audience and adjust any comments. I'm going to close this out. Hopefully everybody's answered in 3, 2, 1. Just share the results real quick. So again, a lot of people learning today and a couple projects out there. We got some already completed, some in the middle of it, and some starting soon. So there you go, guys. And with that, John, I will turn it over to you to get you started.
Great. Well, thank you, Carolyn, and welcome everyone to our presentation on cost segregations and the related tax benefits. We're going to go ahead and start off with a quick overview of the agenda, and I'm going to highlight several of the concepts and key takeaways from the presentation today. We're going to start off and explain what a cost segregation is, and again, hopefully by the end of the presentation, we'll all have a better understanding of what the related tax benefits are going to be for you. We're going to identify tax issues that should be considered in conjunction with the cost segregation study. Honestly, There could be some very significant tax benefits in the first year of doing a cost segregation. But there could be several years before you realize all of the tax benefits. So it's important for you to know the timing of that for you. We're going to identify the most common qualifying assets applicable to a cost segregation study. We're going to discuss bonus depreciation and Section 179 expensing election. These are two very powerful provisions in the Internal Revenue Code, which will allow you to accelerate tax depreciation much more rapidly than a normal straight line or a maker's convention. We're going to briefly discuss some estate planning considerations. And then finally, we're going to discuss the tangible property regulations. And in some situations, you'll see that it's might be more important to take a look at the tangible property regulations before we determine if a cost segregation is necessary. So at this point, I'd like to just turn the presentation over to Mike to get started.
Thanks, John. So just getting started here, basic overview of what a cost segregation is. So it's a tool that's utilized to maximize the return on your initial investment in a construction project through special allowance depreciation. And how that's done is by reallocating costs into asset classes with shorter useful tax lives. So by default, you put up a brand new building, it would naturally fall into the 39-year recovery bucket. So what we're trying to do here with the cost seg is move as many of those costs as we can from 39 years into 15, 10, 7, and 5-year asset classes. So what this will do for you, it'll increase your initial cash flow, reducing your tax burden, and also it can be used to establish a unit of property under the tangible property regulations. And John will touch on that later in the presentation and explain that further. A couple other items to note. A study is most advantageous after new construction of a commercial or residential property. However, you should also consider a study when acquiring a property, when you're remodeling, or just expanding upon an existing property. It's tough to know without getting things started if there's going to be a benefit for a full study. However, at a very minimum, you should look into what you're spending money on and if it's worth just doing a simple assignment of lives. And that's another service that we offer. If a full study doesn't make sense, there's a light version study that we offer as well. So here's an example, just to illustrate what I was going over previously. $10 million new construction of commercial office space. So without a cost segregation, and as noted before, this would all by default fall under the 39-year asset class, which is obviously a rather slow recovery period. So just using the averages for performing a study on an office building, you'll have roughly 25% of the total costs you'll be able to allocate into asset classes with shorter lives. So here I've got 5 to 7 year property and 15-year property, which makes up about $2.5 million out of the $10 million. And you can also see here your year one depreciation benefit is roughly $2.3 million greater than it would be without a study. And that equates to roughly a benefit of $550,000. So next here, this is a general overview of different types of properties within different businesses and what you can expect to reallocate into asset classes with shorter useful lives. So we have apartment buildings here, 5 to 35%. Retail stores, restaurants, and manufacturing facilities. I would say those are the most, I would say, aggressive studies that we could perform, just given the amount of equipment that's within the facility. And when you have significant equipment, you have units of the building property that would otherwise be classified as 39-year real property. However, you have the ability to reclassify that as tangible personal property and recover certain pieces of the building over the recovery period of that piece of equipment. So for example, just use a auto dealership. You go to an auto dealership, you have tons of car lifts in the service department. And in order for those lifts to be structurally stable, you need reinforced concrete. So in and of itself, that concrete is going to have a life of 39 years as it's part of the building. However, you're pouring a significantly thicker concrete pad to support the weight of the lift and the vehicles that you're lifting. So that's a perfect example of an additional opportunity within an auto dealership. Restaurants is another one. You're going to have tons of kitchen equipment. You're going to have special plumbing and electrical feeds for dishwashers, ovens. You're going to have special drainage for disposal systems. So there's always more than what it seems, and without performing a study looking into it, you're just going to be limited to your traditional, it's a dishwasher. Well, that's a 5-year asset. However, there's always more available than just that. So just touch on some tax considerations around the cost segregation. So bonus and/or Section 179 depreciation will apply to the reallocated costs, which would magnify your benefits. And in a few slides, I'll discuss what those benefits are, because they change annually, and it's always an unknown as we get towards the end of the year. Also important to note that unused tax deductions will carry forward to future years. Depreciation recapture. This will apply to personal property in the year of sale. So what that means is basically you take all this depreciation in the first few years after having a cost segregation study done. In the year of sale, you're going to recapture all that depreciation, and it's going to be subject to ordinary income tax up to the depreciation that you took. So that's where it's important to assess your holding period for the property prior to having a study done, because if you intend to sell within a few years, it may not be worth doing this just because of all the depreciation recapture that you'll be subjecting yourself to. So it's important to keep that in mind. Section 1031, like-kind exchange rules. So it can be beneficial with the like-kind exchange. However, the bonus depreciation would only apply to the excess basis in the new property. So that would be a case-by-case basis to see how much your deferral is within the like-kind exchange, to see if it makes sense to have a study performed. But if that's the case, just feel free to reach out to us and we can help you assess whether or not it makes sense to have a study performed in that situation. passive activity rules can prevent a taxpayer from receiving the benefits of a cost seg. So what that means is, and Jen will touch on this further, but if you're not active in this trade or business, or if you're not a real estate professional, your benefit may be limited depending on your overall activity as an individual taxpayer. So that's definitely a huge one to consider, because you can see all these great benefits from the study, but if you can't capture any of those benefits, then it's really not worthwhile. Planning considerations. So obviously this is a widely used planning tool for real estate professionals and investors. Studies are typically performed in the year the construction is complete or acquired. However, if you find that you constructed a new property and you missed out, or you feel you may have missed out on the potential benefits, you can always go back and basically change your accounting method from the year that you originally placed the property in service. And you can do that by filing a form 3115. And you can attach that to your next tax return. And what we would do is make a section 481A adjustment and basically claim all the depreciation that you would have been allowed if you had reallocated various assets into shorter useful lives. So just because you may have missed this opportunity, it's not something that we can't go back and correct.
Mike, sorry to interrupt. I have a quick question popped in here. How far back of a time is this? Like 3 years, 5 years, 10 years? What's a reasonable time frame to jump back to?
Well, it would be 3 years.
Okay.
From the date that you file your return or the original due date.
Okay, great. Thank you.
So now I'll get into some of the various types of tangible personal property that we'd be looking at in a study. So you have your typical equipment, furniture, fixtures, appliances. But beyond that, there's many items of your typical building units of property that can be reclassified into units of tangible personal property, which is obviously the end goal here. So decorative lighting, decorative millwork, removable flooring, carpeting, those are all great examples of things that you might think could be part of the building unit of property and depreciated over 39 years. But these are things that can be treated over 5 or 7 years, depending on their ultimate use. So decorative lighting, the reason being for that is typically your decorative lighting wouldn't be an integral part of the building's lighting system. So if these lights were not powered on, you would still be able to walk through the building and function. So that's how we can break out decorative lighting. Same thing with decorative millwork. It really just adds aesthetics to a room. These are not supporting the structure whatsoever. Same thing, removable flooring. That would be like your luxury vinyl tiles, your carpet tiling. Basically, as long as it's not a ceramic tile that's put down to the floor with mortar or cemented in, where it's obviously it would require a jackhammer to remove. We can accelerate depreciation on that. And as I mentioned before, within a restaurant, for example, you're going to have specialty plumbing fixtures, piping and ventilation, electrical feeds, receptacles that are used directly to power a dishwasher, ovens, et cetera, that, you know, would typically just be part of your electrical system of the building. But since there might have been special electrical work done just to power a specific piece of equipment, that can be accelerated over the life of the piece of equipment that special electrical work is powering. Okay, so the next category I'll touch on are land improvements. So what these are any improvement directly to or added to land, whether the improvements are section 1245, which is tangible personal property, or 1250 property, which is your real estate. So some examples of land improvements would be your parking lots, your sidewalks, roads, drainage facilities, septic systems, sewers, fences, all your landscaping and swimming pools. So these are all examples of units of property that can be broken down into a 15-year recovery period, which would make them eligible for bonus depreciation. So that's important to distinguish these costs separately from the section 1250 building property, which is a 39-year recovery period. So next would be your soft costs. So within a construction project, you're always going to have these costs that go into it. And what happens with these is they're spread out and allocated pro rata based on the direct costs of the project at the very end. So examples of your soft costs are going to be your architect fees, your engineering fees, building permits, general conditions, contractor fees, legal and accounting fees, and construction management costs. So basically anything that you can't tie directly to something that you see on the building that went up. So again, these would be costs that are allocated pro rata to all the direct costs of the project. And this typically would be done at the very end, once you have a solid direct cost number for each of your asset classes. Bonus depreciation. So as I'm sure most of us know, this is already began to phase out under the Tax Cuts and Jobs Act of 2018. So 2022 was the last year of 100% bonus depreciation. And starting with last year, it already began to phase out by 20%. And it'll continue to do so by 20% year over year, all the way through 2026. And beyond that, as of right now, bonus depreciation will be completely phased out. I'm not sure that's going to be the case, but we can only speculate on legislation and what's going to happen there. So for projects ongoing in 2024, bonus eligible property is allotted as 60% of unadjusted costs for bonus depreciation. So what that means is you have a unit of property, you have a parking lot that costs you $1 million. You could immediately expense 600,000 of that, and the remaining basis of 400,000 will be subject to your regular 15-year makers rates. Okay, so within bonus depreciation, there's what's called qualified improvement property. And this wouldn't apply to newly constructed buildings. However, if you're in a situation where you acquire a property or you are remodeling a property, This could be a pretty beneficial tool to you. However, there's a couple of criteria that you have to meet for it to qualify as qualified improvement property. So what this is it's any interior improvement made to a non-residential property after the building was first placed in service by any taxpayer. So what that means is you buy a building that was in service by anyone else, you're able to take qualified improvement property on any improvements you make from that point forward. So the improvement cannot be structural in nature, and it can't expand the building. Also, escalators and elevators don't qualify. So basically, an example of qualified improvement property would be, you're rearranging rooms within the facility, and you're not making the building any larger. You're maybe just knocking down walls. You're redoing some electrical and plumbing work. Changing lighting, things of that nature. As long as that's all within the interior of the building, you're not enlarging the structure, not increasing the building's integrity whatsoever. I mean, that's all going to qualify as qualified improvement property. And that can be taken over a 15-year period rather than your standard 39-year recovery period. And that is eligible for bonus depreciation as well as Section 179, depending on your each individual investor's tax position. So this QIP replaced what was originally in the statute, which was qualified leasehold improvements, qualified retail improvement property, and qualified restaurant property as of January 1st, 2018. So as of that date, those three categories I noted are no longer in the statute. So now it's just qualified improvement property. And now I'll hand it over to John, who's going to go into Section 179 expensing along with a number of other things.
Thanks, Mike. Yeah, so Section 179 expensing is very similar to the bonus depreciation that Mike was just talking about. It's a way of accelerating tax depreciations in the first year rather than waiting for 7 years, 5 years, 15 years, or 39 years in some cases. So Section 179 allows a business to deduct all or a portion of the purchase of qualified property. Okay, so there are definitely limitations on how much you can deduct and how much you can purchase before you begin to be phased out. So for 2024, the total maximum deduction that you could take related to Section 179 expensing is $1,220,000. Now, this is much greater than what it originally was back in the 50s, which was only $25,000. It still is considered the small business expensing election, though. There is, as I said, there's a purchase limitation as well, at just a little over $3 million. So if you spend more than $3 million on qualifying purchases, the annual deduction of the $1.2 million starts to be phased out on a dollar for dollar basis. In general, the Section 179 applies to tangible personal property, usually your machinery, your equipment, furnitures and fixtures. However, the Tax Cuts and Jobs Act did expand the definition of qualifying property to include real property. Next slide. Section 179 now relates to qualified real property. Now, qualified real property is just another classification of property. Qualified real property includes improvements made to certain components of a non-residential building. Okay, these components are roofs, HVAC systems, fire protection systems, and security systems. So although all of those things are still considered 39-year property, they are eligible for Section 179. Similar to the rules for qualified improvement property, the improvements must be made after the date the building was first placed in service for any taxpayer. So you can't build a building, take Section 179 on the roof and the HVAC system. So this is really for improvements made to a building, not the construction of a brand new building. Since these improvements are not eligible for bonus depreciation, taxpayers should consider using Section 179 expense, rather than bonus on certain properties. And what that really means is it's really trying to maximize your total deduction. Okay, as I said on the previous slide, Section 179 is limited to $1.2 million. So to the extent that you can use Section 179 on qualified real property and not have to use it on your 5- and 7-year property, that's probably the best, because you could also use the bonus depreciation on those other assets. Okay, so as Mike mentioned earlier in the presentation, one of the issues that you need to consider is the passive activity rules, okay? And essentially, the passive activity loss rules generally limit the ability for a taxpayer to shelter active trader business income with the deductions from a passive loss. So it's important to understand really what a passive activity is and what an active activity is. So in order to be active, a taxpayer in general must spend at least 500 hours on that activity, okay? So if you don't spend 500 hours on that activity, you're kind of out of luck unless you can meet the criteria of some other exceptions. But from an example's purpose here, if you have an individual taxpayer that has $1 million of W-2 wages from a business that he owns, and he also has, pass-through income from that entity, and both of those, let's just say they total $1 million. And that individual also owns a building that we do a cost segregation for, and we generate $1 million of losses. If that taxpayer is passive in that real estate, he is not going to be able to use the $1 million of losses, the passive losses, to offset wages and other business income. Okay, so that could be a problem. So one of the things that we need to keep in mind, though, is that these losses, although they may not be currently deductible in the first year, they can be carried forward to future years. Okay, and essentially, that is going to help offset any passive income going forward. And we've had this situation for several clients where they have just passive rental real estate. And again, just to take a step back, rental real estate is generally passive in nature unless you can meet some exceptions. So if you have an individual that all he has is this passive rental activity, and he generates through a cost segregation $1 million of deductions, he most likely will not be able to use that to offset any other active income. However, those passive losses are going to be available for him in future years to offset income. So we have situations where we did a cost segregation on a rental real estate, generated $1 million of losses. The taxpayer could not deduct those losses in the first year. So they're carrying those deductions into the future. So they'll never be able to, they'll never have to, I should say, pay tax on the income generated from that activity until those losses are utilized. So again, the key takeaway on this is, you really should plan ahead and account for these rules when considering a cost segregation, because you don't want to erroneously count on these deductions to offset active income. There is one solution. There's actually a couple of solutions to this passive activity rule. And the first one we're going to talk about is a grouping election. Okay, so Section 469 does allow for a taxpayer to make a grouping election to combine a trade or business activity with passive activities, making them essentially one economic unit. So, so that those losses could offset the income. You know, this is an election that is made on the individual's return when they file their 1040. It's a simple statement that says I am grouping this operating entity with this real estate entity as one economic unit. Now, in order to do this, you need to jump through a few hoops or meet a few criteria here. And those certain tests, really the most commonly used one is, to the extent somebody has common control or common ownership of those two entities. So to keep it simple here, you have an individual who owns a manufacturing company. He owns 100% of the manufacturing company. He also owns 100% of a rental activity, a building, and a separate LLC, separate legal entity, and that entity rents or leases the real estate to the operating entity. And if this individual owns 100% of both of those entities, it's really a slam dunk for him to say these are one economic unit. And that will allow him the opportunity to use rental losses to offset this business income. Essentially what we're saying here is that he could own the real estate in the same entity as the operating entity, and he would not have passive rental losses. There's other rules related to significant participation activities, which will allow you to group activities to make them active. Again, the general rule to make something active is to work in that activity more than 500 hours per year. If you have several small entities, okay, where you're not going to get to the 500 hours per year, you can actually group them. And as long as you're not materially participating in those activities under any other criteria, you can group them. So let's just say you have 3 entities. You only spend 200 hours in them. You could actually group them and say, hey, I'm grouping these activities, and I will be considered active in these as a material participant, so the losses would not be passive. Another option you would have is to be a real estate professional. Okay. Again, real estate is usually passive in nature. Any rental losses you have would be passive. However, if you are considered a real estate professional, any losses you have from real estate would be considered active. It's your active trade or business. However, in order to qualify for a real estate professional, you need to spend at least 750 hours in real estate activities, and you cannot spend more than 50% in any other activity. And so what I mean by that is, if you have an auto dealer, perhaps, that has a dealership in a single entity, and he has the real estate that's not related at all to the auto dealership industry, but he's got several of those real estate buildings. You have to determine if, number one, he's spending the 750 hours in there. And if he is, that's step one. However, you also have to determine if he's spending more time in another activity. So are you a Ford dealer, okay, as your primary activity, or are you a real estate professional? They won't let you be both. So if you're spending the 750 on real estate, but you're still spending 2,000 hours on the dealership or the manufacturing or the distributing company, you cannot be a real estate professional. Another issue that Mike brought up briefly was the depreciation recapture. And again, what is recapture? It's just taking back the deductions that essentially you were able to enjoy in prior years. So upon the sale of property, the taxpayer is required to recapture depreciation deductions taken on tangible property in prior years. So again, this is why, if you are purchasing a $10 million building, and you really, may sell it in a couple of years, 2-3 years, does it really make sense for you to do a cost segregation and accelerate those deductions if you're only going to have to recapture or pay that tax savings back in 3 years? That's really an answer, something for, each taxpayer to consider. It's really the time value of money over those 3 years. And if the time value of that money is only $10,000 and it costs, whatever, more than that to do a cost segregation study, it's kind of a break-even proposal for you. So it's something that you have to consider. One thing to keep in mind is that the depreciation recapture on 5- and 7-year property is going to be at ordinary income rates. There's a recapture on the actual 39-year property, which would be at 25%, federally at 2%.
I'm going to jump in again and let Mike answer this question from Karen that just came in before we move to the next topic.
Yeah, so did that relate to the grouping election?
The question is, what if there is not 100% ownership in the related LLC?
Yeah, it's generally 50% or more common control.
You're talking about the grouping election? Yeah, so yeah, I didn't really get into all these criteria for an economic unit, but yeah, it's to the extent of common control, common ownership. I've seen it at 50%. But we've also seen it at less than that as well. So it's really, do you have common control or is there common ownership? I mean, you may have 3 people that own 1/3. Okay, so that's something that you could do of both entities, right? So it's one of those things that you'd have to take a look at those facts and circumstances at all. But the common control would be 50%, but if you then have common ownership, you could have probably more. You could have more than that, and let's say that a third, each one owns 33% of both entities. So it's common control, common ownership of the entities.
Great, thank you. Karen, I hope that answered it for you. If you have remaining questions, just pop them in the box for us. All right, John, I'll let you continue on.
Okay, so as we just spoke about the depreciation capture as being an issue, is there a solution to that? And quite honestly, yes, there is, and that's just don't sell the property, right? Hold it until you die. I mean, that is something that is common tax planning strategy based on the current tax law. And the current tax law, when somebody passes away, they have the opportunity to step up the basis in certain assets. So regardless of how low you've depreciated a property, with or without a cost segregation, okay, when you pass and you give that to your beneficiaries, they're going to enjoy a step up in basis in those assets. So there's not really going to be technically a gain on that. The property isn't sold. The beneficiary is taken on a higher basis. And this is a great planning opportunity too. If somebody does pass away, they never did a cost segregation on this property. It may be very beneficial for on the final return of the decedent to go ahead and do a cost segregation, do the 3115 change in accounting method that Mike mentioned earlier, take all the deductions on the final return, take the step up in basis, and it really not have to recapture any of that depreciation. So tangible property regulations, this is something that we briefly mentioned earlier, and quite honestly, tangible property regulations, might be an option to look into before you actually take a look at and determining if a cost segregation is something that is beneficial for you. So the tangible property regulations were effective in 2014, and essentially what they did is they really, redefined a lot of stuff, provided a lot of guidance to taxpayers and tax professionals on various issues such as a unit of property. What is a unit of property? And unit of property is just a fancy way of saying, oh, that piece of equipment over there, or that building over there. It's the unit of property that we're talking about. And there was certainly some confusion in the past what represents a unit of property, especially for larger pieces of equipment, a big $1 million printing press, let's say, a building, for example. It was important to define what a unit of property is so that we could apply the following provisions to that certain asset. The tangible property regulations also provided clarification on capital expenditures, amounts paid to acquire or improve tangible property. There were a whole bunch of regulations on dispositions of property, but really for our purposes here, we're really going to concentrate and expand on amounts paid to improve property, because that's where we need to determine the difference between capitalizing something or expensing something. So we all understand that if you purchase a brand new building, you're going to have to capitalize that. You're going to have to put that on your balance sheet. You're going to have to depreciate that over however many years with the cost segregation or not. It is definitely an asset on your books. However, the tangible property regulations specifically provided guidance on if you make payments to improve a unit of property, do you have to capitalize it, or is there a possibility for you to expense the amount you're paying? So the criteria that they came up with was three things. We call it the BAR, B-A-R, for betterment, adaptation, and restoration. So if the money that you pay is a betterment or an adaptation or a restoration to the unit of property, if it is a betterment, you need to capitalize it. If it is not a betterment, you can expense it. Okay, so again, a unit of property, if we're talking about a computer, you're talking about your 3 monitors, your laptop, your keyboard, everything that works in connection with each other. When you're talking about buildings, which is really what we're discussing here today, you have a $10 million building, but the regulations broke a building down into various business or building components. Okay, and a couple of those building components that we're going to talk about today is your HVAC building components, plumbing, and electrical. Okay, there's other business components, elevators and escalators and things of that nature, but we're really not going to get into it. So when you're talking about money spent on a certain building component, you need to determine if it's a major betterment to that component, not to the entire building. Okay. And so what is a betterment? A betterment is making something bigger, better, stronger, more efficient. An adaptation is really changing the purpose of something, turning a bowling alley into a movie theater, and a restoration is bringing something back to life, replacing a major component of a unit of property. And I just want to go through a couple of examples here. I see we're running up against the clock here, but replacement HVACs. If you have a building and you have 10 rooftop units, the regulations state that if you only replace 30% or less of those units, you can expense those. So if you have 10 units and you replace 3, you can expense it. There's no reason for tax purposes to capitalize those. If you replace more than 50%, it is clear through the regulations that you have to capitalize those. However, from 30 to 50%, there's a little bit of a gray area there. Another example that is right in the regulations that we have relied on is replacing a rubber membrane on a flat top roof. They can cost $300,000, $400,000. And back in the days, we said, oh, that's a new roof. We have to capitalize that. Under these new rules, it's really not a new roof. It's a new component of the roof. So if you think about the roof like having various components, you have the ballast, you have the rubber membrane, you may have tar paper, you may have support systems, you may have joists, you may have insulation and decking, whatever. If you're only replacing one part of that, it's not a new roof and you don't have to capitalize it.
Before you move on again, John, Nick now has a question. How does the allocation of building or land factor into cost segregation if the study is completed in year of purchase or later?
So pieces.
How does the allocation of the building or land factor into cost segregation if the study is completed in year of purchase or later?
Yeah, so absent an appraisal on the real estate, your technical answer is you have to rely on the assessed value of the real property, which would be within that jurisdiction's records. That's your technical answer.
Yeah.
Yeah, you're kind of stuck with that.
Yep, you absolutely have to break out the land. Land is never depreciable. So you have to break that out. And if it's not broken out in year one, I guess that's really, an issue that you could always do a change in accounting method to break that out, but I'm not too sure what you would do there. Yeah.
Okay, hopefully we answered that for you, Nick. If not, let us know and we'll let you keep going on, John, in our last 5 minutes.
Sure. Demolition, I'm just going to talk real quickly about, demolition considerations. When a building is demolished, the building basis must be added to the land. So you have an opportunity here to do a cost segregation before the demolition to pull out any of those 5, 7-year and even land improvements out of that, that capsule, that 39-year bucket there, and dispose of them rather than adding them to the land. Cost segregations are also going to help with partial dispositions, and this was a very valuable tool, very helpful to many of our clients when these regulations first came out. We were able to do a late partial asset dispositions where we could actually go back in time as far as we want to take things off the books, to deduct expenses, things of that nature. Now you can only do it in the year of the disposition. So, cost segregations help out significantly here with partial dispositions. I've seen it several times on my auto dealer clients, where you have a manufacturer that 1 year says, hey, we want the showroom to look like this. A couple of years later, they say, hey, we want you to do these improvements to the service area. A couple of years later, you have to do these improvements to the reception area, things of that nature. These are demands placed on the dealers by the manufacturers. And then a couple of years later, they say, hey, we want you to redo the whole thing. So redoing the whole thing is, then you're disposing of these improvements that you may have capitalized in prior years. So that's important to do a cost segregation to make sure you know what you can pull out. The following, there's a couple of lists here, a couple of projects that commonly result in a partial disposition. Roof repairs. That's something that we've seen recently. Down in Eden, unfortunately, there was a tornado that ripped a roof right off. If you got to replace that whole roof on there, you're going to capitalize the whatever $500,000 to replace that roof, but you still have the roof on the books, the original roof. So why would you be depreciating 2 roofs? Doing a cost segregation is going to help you understand what that original roof cost and help you to dispose of it. The next couple of slides, are really flow charts that, will help you make decisions. Obviously, you can call, me, Mike, or myself and walk through any questions you have. And then, the next slide is a little, frequently asked questions. What's a typical time frame for a study? Again, 30 to 60 days. It's really dependent on the availability of the records and how far we have to go back to find those records, or if it was a new purchase, do you have the AIA contracts right at hand for us? How much does it cost to do a cost segregation? Usually $10,000 to $15,000, but as Mike mentioned earlier in the presentation, we sometimes do these light studies or maybe just an assignment of lives. Those could be as little as $3,000 depending on the work that is involved with it. I guess the important thing to take away from this is, if you're not comfortable, accounting for, improvements or things of that nature, definitely give us a call. It could be an easy question like, oh no, just expense that. You don't need to capitalize that. It may be a little bit more involved, but it's important to do whatever you can to maximize the tax benefits when you're spending this much money. So the next, frequently asked questions is, how much do I have to spend before a cost segregation? I should consider a cost segregation. And we've done them on buildings as low as $750,000. But obviously the higher the dollar amount you spend, the bigger benefit that you're going to receive. And with that, I think that's all the time we have. Carolyn, is there any other questions in the queue?
Great, yeah, so let me check the queue. I am gonna share one more poll with our audience if they want to type in any of their questions in the question section, or that kind of aha moment for them today to let us know what that was for you. And then if you would like anybody to follow up with you directly, just put that in the poll for us. We're here for another minute or two to answer any questions that you have, so throw it in the question section. And we had some great questions already submitted, and hopefully we got those answered for them throughout the presentation. So we appreciate you sending those in. And I think that's gonna wrap us up for today. Thank you guys. This was very helpful, very informative for everybody. And we appreciate all your expertise and examples. Thank you, everybody, for joining us.
Thank you.